people's jobs now, obviously at risk. We're hearing a lot of layoffs here lately. So on your site, it says, how AI proof is your job? That's like one of the first questions that pops up there. So what is that?
It's always possible that this technology is more transformative than anyone in the past, but it doesn't necessarily have to bear out that way.
March Madness, comparing it to like the narratives of global. What does the military conflict globally, what does that mean right now?
It's been sort of an interesting ride in 2026. And we like to make the analogy to March Madness. The market's just behaved a lot like it. Right? Everyone goes in with their priors about which teams are likely to win, which sectors, which stock.
The opportunity of AI where people could essentially work less, but still get paid the same, but then have opportunity within those hours because AI is taking over certain things to be reassigned.
There's so many ways that AI could impact your job prospects going forward. Even if there aren't layoffs or even declining employment in your overall industry, that doesn't mean that you're safe. And the example I like to use there is
systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome back to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser. Excited to bring this conversation to you all. We've done a deep dive here over the last couple of weeks, especially around marketing, talking about some best practices for financial professionals. We took a deep dive into the last episode around AI, and I'm very excited about our guest who is here. He actually came out with a book here earlier this year. That book is titled AI Economics: How Technology Transforms Jobs, Markets, Life, and Our Future. He is an associate professor of economics at Brandeis University and an advisor to the Shiller Barclays Cape family of index products. We have none other than Benjamin Shiller, who is very, very excited to have you on. Actually, I had your dad on a couple of years ago. I don't know if he ever told you that, but how are we doing today?
Yeah, great. Happy to be here.
Yeah.
Doing well. It's finally a little bit, well, I know this will probably be recorded, but it's finally a little cooler here in Boston. So it's a great day.
Good old Boston. And, so I mentioned here, and we got a lot to dive into around, especially for some of the advisors that listen to the show around the Shiller Cape indexes. So we'll talk about that. But just in curiosity, so you came out with a book here earlier this year. How long did that take you from start to finish?
That's an interesting question. So as someone who studied technology, I thought it would be almost silly to avoid using AI in the writing process.
Yeah.
So I actually started that book last July and I got it published in February. So it was a very quick timeline, which I think is important when you're studying new technologies because everything changes so quickly.
Yeah. And I am going to actually take a deep dive into that because I know for the most part, and basically with your history, it seems like, you guys and your team usually have your thumb on the pulse of what's coming. So, and for those that don't know anything about, obviously your background, can you share a little bit about, who you are and where you're at today? And also a little bit about obviously being a professor too. So,
yeah. So I've been a professor at Brandeis since 2012, studying various topics, including finance and technological change. It's actually sort of a funny story how I got into it. When I went to college, I went there as an 18-year-old me, and the last thing that I wanted to do was to actually choose the same major that my dad had specialized in. But it turns out that I really enjoyed the economics classes and was pretty good at it. So I went into it despite that fact. So then when I went off to grad school at the Wharton School, I really got interested in sort of deeper dives into quantitative economics and studying various questions. Since I've been at Brandeis, I've looked at a number of different topics in my research. I have some research with the Barclays team looking at these Cape products. I have a great team that we're working with over there with Ben Redmond and David Hayfliger and many others. And I've also worked on other topics, including my technology book and topics like personalized pricing and basically how technology transforms markets. It's been a fun ride.
Getting a couple things, a little bit about your history, utilizing technology at our fingertips, right? So I look back and looks like you had some interesting articles here recently that you wrote. And I know that's fascinating that you wanted to basically avoid what your dad was doing, but yet your interests still align there. So what kind of on the world's scape here? So if we're looking at like narratives and we're also looking at the impact narratives, but then you have like world conflicts, like military conflicts on the global scale. So you wrote some article about like the NCAA, like there, you did a great like analogy of the March Madness, comparing it to like the narratives of global. So what does the military conflict globally, what does that mean right now?
Yeah. So, well, it's not just a military conflict, I would add. It's been sort of an interesting ride in 2026. And we like to make the analogy to March Madness. The market's just behaved a lot like it. Right? Everyone goes in with their priors about which teams are likely to win, which sectors, which stocks. You think about the stock market.
Mm-hmm.
And largely that's based less on fundamentals and more on narratives, basically, sort of thinking about what might happen in the future. Now, an interesting question is perhaps not whether the favorites were right when the upset happens, but rather how much they have to fall, like how much was riding on them being right that they were the favorites. And that's where you can see some of these teams or these sectors or these stocks falling quite far. If you think about it, particularly with stocks, that's where valuations really matter. That's why we use the CAPE ratio, right? A stock with a high CAPE ratio isn't just expensive. It's the market betting that they're going to make a deep run on the tournament, in the tournament. The narrative is already baked into the price. And so if they falter, if there's an upset, those are usually the teams that have the farthest to fall.
The thing with the CAPE ratio though, so I mean, literally getting to know more about the Barclays, the whole team, it seems like for years now, it's been priced too high, and it just keeps going up, right? So like, why is that? Like, why is it?
Well, so it's always easier to look at this when you're looking backwards rather than forwards, but markets can go up for a long time if it's a bubble or not. But if you look at the data, look at the overall market, the CAPE ratio right now is around 41. And that is exceptionally high by historical standards. In fact, it's only been higher in the dot-com bubble. And if you look back to the beginning of our data set, 1881, the CAPE ratio has been higher than it is today in 23 months out of 1,746 months. So we're in very unusual territory. Now, historically, when the CAPE ratio has been this high, the returns have been low, something like 3.2% annualized over the next 10 years. If you're looking at nominal terms, I think it's actually negative in real terms. Now, this time could be different, right? That's always the bet. But if you look throughout history, through these different transformative technologies, electricity, the internet, computers, right? Time and time again, people have sort of gotten exceptionally excited, perhaps more excited than the new technology justifies. So, it's always hard to say what's going to happen in the future, but the price does look very high right now.
Retirement isn't built in a day. It's built on a strong foundation. Talcott's fixed index annuities help protect against market downturns while offering real growth potential. The Everguard Assurance delivers guaranteed income you can count on, and the Everguard Aspire offers strong growth potential with competitive rates and caps, plus a no-fee bonus to help clients stay strong all the way through the age of 85. It's all part of a commitment to help advisors and clients move forward with confidence. Talcott, a foundation you can depend on, a trusted partner for what's next. If you would like more information, go to talcott.com and make sure you learn more. Once again, that's Talcott, TALCOTT.com. So, I mean, especially since the last, so I guess 6 years or so now of doing just the printing of money, I'm sure that has something to do with, for the most part, of just, I mean, eventually, right, you would see the CAPE ratio continuing to rise. And then it seems like when things could weather, if we just keep printing money, that can't be good for the economy, correct?
Yeah. I mean, so if you keep printing money, people keep on having money to invest, but then you have this problem with inflation, and that creates its own problem. So, right now the government is trying to thread the needle, as they always do, trying to tame inflation while not, leading to a small recession. And the question is, can they thread that needle? I think the worst possible outcome is runaway inflation, right? If we don't keep inflation under control, that leads to all sorts of problems that percolate through the economy. I would say that the inflation doesn't actually impact the CAPE ratio, because the CAPE ratio is adjusted for inflation. It's in real terms, so it's sort of agnostic to that. So it's more about the real world impacts. And people seem to have this narrative that you should basically keep betting on the stock market. Almost every time there's a decline, people view that as an opportunity. And it's starting to look something like the 1920s. I'm not saying we're going to repeat history there, but I have friends who are calling me up and telling me, I should be investing in crypto. And these are friends from high school who are not in finance, right? They don't even have much of a quantitative background. And they're trying to tell me, the economics professor, that I should be making these investments. So it's very strange times. Now, it's always possible that this technology is more transformative than anyone in the past, but it doesn't necessarily have to bear out that way. And an analogy that I like to make is to water, right? If you think about these very powerful AI technology, they are powerful. I use them to help write my book. I use them all the time. But just because they're very powerful doesn't mean that they're going to be profitable or that the stock is going to perform very well, right? So thinking back to water, what's more valuable than water, right? You need it to survive. You would pay whatever you could if you had to, but no one's cornered the market. There's no monopoly there. And so water is dirt cheap. And if you think about some of these, AI companies, right, you have Anthropic, you have OpenAI, you have Gemini. Yeah, Anthropic seems to be the big winner right now. Like, they're the ones that seems to be offering the best model. But if you go back less than a year, it was briefly Gemini, and before that it was OpenAI. So they're sort of trading back and forth, and in the long run, there might not be much that distinguishes them. So if there's not much that distinguishes them, then how do they distinguish themselves? It's usually on price, and that could lead to lower prices, which would be great for all sorts of sectors if we all had cheap AI, but it's not necessarily great for the ones delivering it. And just to make an analogy to the dot-com era, right, Cisco was sort of similar to NVIDIA, right? It was building the backbone of the internet, just like NVIDIA is the backbone of these AI models. But if you had invested in Cisco near the peak of the bubble and held it since then, the cumulative return is something like 125% compared to the S&P 500's return, which is over 400%. It wasn't a great bet. What are the companies that really succeeded in the years since then? It was the companies that built on top of the internet. It was the Googles, it was the Facebooks, the Netflix, the Amazons, right? And so you could see that even the sectors that are overlooked right now, if they can build, and develop using AI, maybe healthcare. Healthcare is fairly cheap right now. They might be able to use AI extensively. And so it could be these sectors and companies that people don't anticipate that have the, largest gains over the next period.
Yeah. And I'm sure, especially as you were writing your book, it was, it's one of those two of like, are we just like getting ahead of like the uncertainties of how fast things are transforming? It seems like utilizing AI, businesses just openly just, leveraging this to insert below the line activities into AI that creates opportunity to be more efficient as a business. So from there, I mean, the downstream effect from that are people's jobs now obviously at risk. We're hearing a lot of layoffs here lately. So on your site, it says, how AI proof is your job? That's like one of the first questions that pops up there. So what is that? Or why do you phrase it that way?
Oh gosh, yeah. So it's really hard to predict, but there's so many ways that AI could impact your job prospects going forward. I think I'll start potentially with the most surprising idea of all. Even if there aren't layoffs or even declining employment in your overall industry, that doesn't mean that you're safe. And the example I like to use there is doctors. You think about doctors, they were largely selected on skills that related to diagnosis and memorization. Those are two skills that AI models are actually really good at. So if you're a doctor today thinking the AI can proxy for those skills, then the question is, what skills am I adding? So what is the human value add to these AI models? And you might argue that it's bedside manner, interacting with patients. But if that's where humans add value, then people who were selected on a different set of skills might find themselves as no longer the best people for those positions. So you could have these doctors with massive medical school debt who then no longer find themselves, best for the job.
Hmm.
And I could go into a lot of detail here. I don't want to get too much in the weeds about sort of which jobs are safe. I'm happy to talk about that if there's time. But I think an important thing to note is it's very hard to determine whether your job will remain sort of immune to AI's capabilities. If you were to go back 25 years and even ask technologists whether they thought self-driving cars could operate on roads with other humans, they would have said no. I mean, I know personally some leading technologists who said that's impossible. That was the example they used about what algorithms couldn't do because it's too difficult, too unstructured, too many unusual cases. But here we are today. Waymo's, offering a legit self-driving car service in I think it's 11 cities now. So it's there. And just a couple of years ago, I saw this paper presented where people were using AI agents to fill in for human survey respondents. Right? What's more human than giving human opinions and telling, people how humans would behave and respond? And yet now there are companies launched with this business model using AI agents in place of humans in surveys. So I think it's very hard to predict where the market is going, whether your job will be safe, whether you'll have high earnings, even if AI doesn't touch your career, because people who are displaced will look for a different profession, and suddenly you might find a lot of people competing for your jobs, which might help push down wages. It's just so hard to predict. And I think that's where you need to have a strong financial plan, not necessarily relying on your career as being as safe as it has over the last 30 or 40 years.
What if your clients could access one of the biggest investment trends of the decade without sacrificing the protection of fixed index annuities? With Ibexus, they can. Their newest index options provide access to crypto-linked growth potential through the fastest growing ETF in history, plus exposure to the world's most recognized U.S. equity index, the S&P 500, through an innovative volatility-controlled strategy. More innovation, more diversification, more opportunities to differentiate your practice. Contact Ibexus today and see what's next in fixed index annuities. And that leads me to, I don't remember if you said it on the podcast. There was a Professor Siegel, actually, either it was earlier this year or late last year. He mentioned and referenced the opportunity of AI where people could essentially work less but still get paid the same, but then have opportunity within those hours because AI is taking over certain things to be reassigned elsewhere. So is that where you're leaning towards as well too, or is that like way too out there at the moment?
It's tough to say, but people made that prediction almost 100 years ago, that the automations then would lead to us working less. And it seems that we work more now, especially if you consider the number of people in the workforce. If you look at these coders at these AI companies, they're actually burning out. They actually feel that because they're more productive and because they need to check back when the AI models finish doing the work, that they're working all hours of the day. They're actually sleeping less than they used to. So it's sort of unclear where this will happen, but there is certainly an argument that if AI makes you more productive, particularly if you have, highly specialized skills, then that's going to increase the returns to, developing these specialized skills, which might cause us to work more. So while I hope that Jeremy is right, I'd love to have a future where I can, create the same output, work a little less, play a little more tennis, play a little more soccer. It's unclear where it's headed.
Yeah, it'll be interesting because I think we're going fast, and like you, I have similar probably age demographic friends where crypto and all these things where we could be getting an opportunity to have upside, and who knows, but I mean history repeats itself, and that's something I'm starting to see a lot more lately. So it's interesting to watch how AI and people immediately feeling like they don't want to fall too far behind as a business when other competitors are doing it and they're hearing all the wins. But who knows? Like I said, the down trickle of what actually happens to those businesses.
I mean, it's really interesting with retail investors in particular, right? Retail investors can be very smart, but if I think of most retail investors, they have another full-time job, right? So it's like hard to really dig in and look at each of these companies in the same depth as someone who has, a full-time job spent doing it. And so I think that there's a lot more people making decisions in investments based on narratives, based on incomplete information. And so then you have these narratives and this exuberance driving the market. Now, the way I like to think of it when my friends suggest crypto is, it's possible that crypto will do really well, right? Like if I had invested in crypto the first time anyone had suggested I invest in crypto, I would have done really well. But there's sort of nothing backing it up. It's all based on what other people are thinking. It's sort of like tulip mania of sort of the older bubbles. Whereas if you choose these stocks that have stronger fundamentals, then even if everyone else sort of cools on those stocks and isn't excited about it, you still have the companies earning money. They're still going to pay dividends. They're still going to get money to you somehow. And so I think it's really important that we be careful in a time when narratives are really driving the market because, especially for people who are getting closer to retirement, if there is a big crash in the market, that could be quite disruptive for people.
So how do you think financial planning is going to evolve though? So with technology at our fingertips, I mean, you could say, you could make the argument for financial advisors as business owners and CEOs. Probably the one thing is obviously what separates them from others. Most would say it's their intel of knowing where to help guide their customers around picking stocks, picking different things. But someone could make the argument that there's going to be tech that can take care of that for you. So maybe you should, as a business owner or advisor, focus more on that, the art of human connection, just make sure you connect with advisors. So how do you see that evolving over the next here near future?
It's a difficult question, but I think the human connection really matters because, financial advisors are often underappreciated, right? Like people in finance are often underappreciated. They're given a bad rap, but they're solving real problems. And while these, models can suggest things, you have these AI models, they can suggest investments. Ultimately, people decide, which investments to go into. And a big problem, I think perhaps devastating problem for a lot of people, is that they get so caught up in the narratives that they're not really thinking, you know, clearly about what types of investments they should make. So they might think, I don't want to miss out on these hit stocks. I mean, I see that myself. I bought one of these NVIDIA cards for my research back in 2016. And I remember thinking like, this is an amazing product. I should really invest in this. But then I had my second child and things were really busy and I never got around to it. Now the stock's up something like 150 fold. And I'm sort of sitting there thinking, well, should I invest in it now? I already missed out once. Maybe I should invest in it now.
Mm-hmm.
But investing that way is not necessarily the most sensible strategy, right? You need to think about the risks. You need to think about sort of what are my goals. And I think a human can help sort of translate that to people better. It can help them make the right decisions. I think that, when people really think about it, they are quite risk averse, right? You don't want to risk running out of money someday. And I think that a good financial planner can really help them sort of take this sort of global, higher level picture and think about what are the right decisions, not what am I most excited about today.
So speaking of, for instance, your example right there. So what is driving the market? Like where are you seeing good opportunities for market returns based off the narratives that are bubbling up now?
Yeah. So the Cape family of products have actually largely been successful by looking where the narratives aren't, right? It's sort of, even if a technology is very transformative, even if it's very profitable, you could still have prices driven up to levels that, can't be justified based on the future earnings. And we actually did a research piece back in 2024 where we looked at where the outperformance from the CAPE products came from. And we found that it was sort of catching up in the PE ratio. So basically, some sector or some stocks would underperform, or not even actually underperform. That's actually the wrong direction. It's not actually what happened. What happened is people get excited about something else and they drive up the prices of these other sectors. And, you have to raise the money to buy those stocks somehow. And so they'd sell off the sectors that they're less excited about. And what we showed in this research is that the sectors that the CAPE products were invested in would tend to catch up in the PE ratio compared to other sectors. And that pretty much explained all of the greater than 2% outperformance relative to S&P 500. So I think it is using narratives, but in a sort of very different way.
New product alert. Revel One Financial is continuing to rev it up. At Revel One Financial, their mission is to revolutionize how people feel, think, and experience retirement solutions. They are bringing unmatched agility, speed, and innovation to the fixed annuity industry. And now Revel One Financial just announced their latest product launch, introducing a CumRev fixed index annuity with a 10% 7-year guaranteed cap rate with the S&P 500 1-year point-to-point index interest rate on the 7-year product. Rate subject to change at any time, but you heard that right. 10% cap on the S&P 500 guaranteed for the 7-year contract. CumRev also has an index lock rider with 3 ways to lock in performance. Another launch, another leap forward. That's the Revel One Financial Cheetah Spirit, built for speed, designed to deliver. I can second that because I know following your team's forecasts and reports going back to like 2020, your team was talking about Japan literally in 2020, and sure enough, it's interesting. So the S&P is still doing well, but I think I just saw something on one of my feeds here recently talking about Japan possibly raising their interest rates and good opportunity there, and just it continues to be strong. So what's like a good example today of something that your team might be looking at what others are not, especially for the bubbles? So both sides looking for something for opportunity where most people aren't looking, but also what bubbles do you see kind of bubbling up at the moment?
Yeah, so it's a good question. So the US, the prices are very high if you look at the CAPE ratio. That's not true around the world, and it's also not true for all sectors within the US. Right? Consumer staples, healthcare, real estate, those all are more affordably priced. And so we tend to take the view that you should look at the fundamentals. That's sort of the safer bet. It has led to outperformance, as indicated by a long history, both live track record and in the back test before then. But there's also advantages in that it reduces the drawdowns, how much you might lose, which I think is particularly important for these types of annuity-like products where you don't want someone to take a big loss before it converts into a monthly payment. So, I think there's been a lot of advantages there by looking where others aren't. Right now, Europe is fairly cheap if you look at the CAPE ratio. Other markets are as well. So if you were thinking about investing globally, there's certainly, if you look at history, potential for greater gains and also much lower risk of taking a severe decline in your investments. So I think there are also a lot of opportunities out there in stocks, not, specifically in stocks, just not necessarily in the US. In the US, you're really banking on this narrative that, the US's AI companies are going to be transformative. I think it's probably gotten even more extreme today, but there is this statistic that, what was it? I think the US was 5% of the world population, 25% of the earnings, and 65% of the stock market cap. And this was a couple of years ago. Right? So long term, is the US able to sort of account for that much or even more of the economic output of the world? Right? That's the bet that we're placing right now, because with the CAPE ratio being so high, we're not only betting that the US will continue to do well, we're betting that it will do even better compared to the rest of the world than it has even recently. And so that's, it's a bet, but it's all based on narratives. And if those narratives aren't fulfilled, then the market could have quite far to fall.
And you just mentioned it too. So talking about especially financial planning, people looking for not outliving their money, looking for principal protection. So, like what your family's had a huge splash in literally, I think the first index y'all's team put together, it came out, I want to say in 2024 or no, sorry, 2014. So it's over a decade long.
Yep.
So you guys are no stranger to the fixed index annuity space. So what are your thoughts of that space itself? And, what do you think the future is for FIAs?
Yeah. Well, you said it. I mean, it's really solving a hugely important problem, right? Like you bear the risk if you don't buy one of these of it's kind of funny to say it, but living too long, right? Living to the point where you're destitute and get to the point where you're disabled and haven't been in the workforce for a while and don't really have any way to raise money. But some people sort of take the other extreme and they want to just get a fixed monthly payment right now. And if you even if you don't get the monthly payment right now, but it's at some future date, if you want to have a specified monthly payment, then for them to do it, they have to invest in safer assets, which don't historically provide as good returns. And so many other people will choose these products, reinvest in the stock market for a period of time, and then it converts to a monthly payment. And if the stock market goes up a lot, then you get a higher monthly payment, et cetera. The CAPE products actually provide a nice balance. Actually, well, it's actually not even necessarily a balance because it's outperformed the S&P 500. So it's sort of at least historically, a win-win. I can't make any promises for the future.
Right.
But the CAPE products have a lower drawdown, they have less volatility. And so you're not taking as much of a risk that your stock investments will go down over, especially a longer period like 10 years. And so it sort of offers less risk than stocks while still giving the upside, right? You're still invested in certain stocks. It's actually overperformed. So you get a lot of that growth before it converts into a monthly payment without some of the risks of a severe decline. And then once it converts to a monthly payment, then you sort of get that guarantee going forward, which I think is especially important today, right? Because a lot of people might think that, they'll keep on earning money over the next period. They don't necessarily need to rely on that fixed payment. But with jobs getting so much riskier today, you can't bank on that. And so it makes financial planning, in particular, careful and reserved financial planning even more important, where many people are doing the opposite. Their career's at risk and they're taking risky bets with their investments. It seems like a situation that could backfire spectacularly.
Advisors in 2025 are looking to grow, scale, and capitalize on their business through systems and processes that have been proven by other entrepreneurial advisors here over the years. And here at Simplicity and SureMark, we've made it very easy for advisors, providing our one pager. That one pager is titled AMP Path to Prosperity. A couple of check boxes in order to talk about the systems and processes that entrepreneurial advisors are leveraging in their business to help them not only what sells for them when they're not there, but also take tasks off of their plate by delegation and plugging in to some of the financial technology that's offered today to make their business more efficient. So if you would like our one pager and you would like to fill that information out, make sure to check out insuremarkamp.com/Jeremy and click on Learn More for our AMP Path to Prosperity. I'm in this space, and until you just said that, that kind of just like the light bulb went off in my head of talking about the fact that, we're talking about AI, talking about these opportunities where could jobs be at risk, but yet people are going to need streams of income that they can't outlive. They need some type of certainties. So, I mean, there's several, and it's crazy to me. So, like for instance, yourself, obviously, doing all the research that you do, and consumers love these type of things, but there's a lot of financial professionals and advisors out there that just they don't want to look at it because they're making the bets that the market's just going to always continue to perform. So it's almost to where there's always an opportunity to have one and the other complement one another. But some advisors, for some reason, they just refuse to want to look at it. Although I've seen a lot more of the advisors starting to go into the same camp now for FIAs and considering those as good alternatives for their customers. But it's interesting. I didn't even think of that with the amount of jobs that are possibly going to be gone here in the near future, maybe. This is something to maybe look at. Or for your team, so if you actually look at your indexes though, so real performance, so that's the best thing too. So looking at the Shiller Cape slew of index options that you all provide, if we were to just focus on the main ones that are within the fixed index annuity space, I mean, same principles for each one, or what's mainly the I would say your secret sauce for the indexes that your team feels that you don't have to make a lot of adjustments on?
Yeah, I mean, most of the adjustments recently have been minor tweaks to a strategy that has worked. It works across different geographic regions, different time periods. So we don't want to sort of change too much because of the track record, because it's sort of established performance. I think a very important point to make is that there's a decent moat here because our products use not just the raw CAPE ratio, right? Using the raw CAPE ratio, you can use that and it could help you find some bargain, stocks or sectors, but they could be cheap for a reason, right? Maybe people are correctly predicting that those are not the most exciting sectors, right? Historically, technology has done a lot better. So what our products use is actually this relative CAPE ratio, where at least for the sector indices, we take the CAPE ratio of the sector and we divide it by the historical CAPE ratio for that same sector. So sort of normalizing it in a way. And when we do that, the sector indices will rotate into technology at times. It's rotating into growth areas when those growth areas are cheaper than they tend to be. And they tend to, rotate into safer, sort of more value sectors in other periods. And so that strategy has worked really well. We're the only ones who have the data. And so, we think we can keep on applying it to other areas. Now we have added some tweaks, right? We have this, tilted index, which might enter there at some point, which sort of, instead of just choosing the 4 cheapest sectors, it sort of skews it a little bit relative to the market cap. So it sort of keeps a little bit in technology. There's sort of some other overlays to address, volatility risks. But by and large, we think, if we have something that works, we don't want to mess with that too much. And we definitely don't want to over-engineer it. So, we want to be very careful in making sure that we don't create any risks for our customers. We want to do well by them. And I know that's something that, it matters to me, but it really matters to my dad.
Mm-hmm.
It's been true throughout this partnership, and especially now, that he cares a lot about how he is remembered. Right? He doesn't want to be remembered for giving people a product that has not done well. And so he's always very proud when he thinks of these. It's also been used in like these pension schemes, the nurses or other sort of public servants pension schemes. And he feels great when it has done very well for them. So hopefully that will continue. But that's sort of, we're very careful about designing products and not overextending.
Yeah, just doing the right due diligence, having the right partners. And I think the thing that goes through my head is monthly rebalancing. The amount of information, you just did a book on AI. So the amount of information that can travel and how fast it travels to create narratives that maybe aren't even narratives. Do you ever see going away from those basics of monthly rebalancing, or how do you think, but what are your thoughts around that?
There's a big team of us working on it, right? We have the Barclays team. There's something like 8 people on the weekly calls there from Barclays and 4 people from our side. So it's always something that we're exploring. But I think if you think about the intuition for how our models or how our investment products have worked historically, it's working sort of as a contrarian, and the narratives help us. So, in the short run, there could be a run up and we can underperform. And, you never know when things are going to change. But when the narratives are really picking up, that's sort of pushing the valuations far from their sort of fundamental value. And then if we have this rotational strategy, which is sort of picking up where the bargains exist, that should be stronger in the longer term when people are sort of excessively building up the price of some of these hype sectors. I think I should just mention here, if people think about the AI sectors, the investments that these companies are making in data centers and chips is enormous, right? The investments are something like $5 trillion or about 1/6 of a year's of US GDP. And, going back to the earlier conversation, if these companies don't have a moat, if they don't have a monopoly of some sort, then they might not be able to recoup these costs. So, you could certainly come up with the arguments that seem quite sensible that maybe these sectors are overhyped. And if they are, then you're going to see, as we have it many times in the past, that people who sort of stuck more to fundamentals and trying to remain disciplined have sort of better performance, right? Like that's what you see over time and time again. Sometimes you have a few examples of people bragging about their winners, but people don't brag about their losing stocks, right? They just stay quiet about it. And historically, it's the people who are sort of more disciplined that tend to do better over the long haul.
Maybe to that point of the data centers, I mean, that's a hot topic. And I believe it was in Utah, someplace recently, but the people rose up and now I don't know where that left. So, I mean, it's one of those where if people don't want those necessarily in their area, is it too big to fail? It's going anyways. So what's your research based off AI economics? Like, where do you see predicting how that all plays out?
Yeah. Well, demand is going to continue to grow. So you see this in each major technology shift, that there's this, what they call a J curve in productivity. So when something comes out, people are basically trying to learn how to use it. They're trying to figure out what works, where it helps improve productivity, where it doesn't. And over time, they then learn that. And you get more and more people starting to use these technologies. And eventually, people figure it out and then they start using it really heavily. And so I think the demand for this is going to increase quite substantially. It could reach the point where these models are no longer cheap, or even humans become cheap if there's supply constraints. I mean, I am convinced that these technologies are going to be very useful, but it's a different question about whether they're going to be profitable. So I do see a future when AI is used very heavily. I do see a future where AI disrupts jobs. But if you think about the political economy of it, if something even like 3 or 4% of US citizens are laid off from their jobs because of AI, that could certainly be enough to swing national elections.
Mm-hmm.
And so, I think there will be pushback. I'm kind of nervous about it because long term, I think we will do very well if we win the AI race. But I think it's quite likely that living in a democracy that the political economy will matter. And I could see data centers being heavily restricted, certainly in my state. I don't know about your state.
Well, yeah, it's definitely it's up in the air always.
Yeah.
Yeah. So, but I know so like if we go back to hot trends that are being consistently in the news, narratives that could be formed, the market is roaring. At the end of the day, like here we are celebrating the 250th anniversary of our country. We'll probably be close to the all-time highs in the market. Maybe potentially, I don't know, as we record. So do you feel the market, is it undervalued at the moment for here in the S&P 500, or what evidence gives you, do you think we're in a good spot? Do you think it's undervalued or overvalued?
Well, I'm always very hesitant to make these predictions, but if I go back to the fundamentals, the CAPE ratio, as I mentioned, is very high. And so, the bet again is that this time is going to be very transformative. I think that if you look throughout history, people tend to get overexcited. And so I think that it's probably a bit overhyped. Right now, we haven't actually seen the job losses. We've seen the productivity gains. And I mentioned that I used AI in my book. An interesting stat is that 2/3 of books released in 2025, or it's actually 60%, close to 2/3. 2/3 of books released in 2025 were written by AI, according to some recent research. And what we've seen is the productivity gains, but we haven't seen, the job losses. Now, Maybe the market can support all these new books, tripling in the number of books released each month. Right? In some sectors, you see it. You see that demand is what they call inelastic, that if price falls a little bit, we demand a lot more of it. And so actually that could lead to rising wages. But in a lot of other sectors, other areas, you see inelastic demand. The example I give in my book is farming, right? 200 years ago, 80% of people worked on farms. That's fallen to 1% today because demand is inelastic. Basically, we get full. We don't want that much more food. And as it gets more productive, we just need fewer people to make it. So we could start seeing some massive job losses as then the economy starts to sort of shake out somewhat. And when you start to see the job losses, then you could start to see the decline in some of these stocks as well. A lot of this is driven by retail investors who have a lot of money that they can have at their disposal. They keep on printing money, keep on sort of supercharging the economy. And so that means that people have more money in their bank accounts to put into stocks. But we could see the reverse of that. If people start losing their jobs and start eating into savings as they spend time retraining for another field, as they end up being pushed to retire a little bit earlier than they had anticipated because they're displaced shortly before retirement. And so we could see the reverse happen. There's just no guarantee that we're going to fulfill these narratives. And if the companies aren't that profitable themselves, if this is sort of a general purpose technology that many people benefit from, then why is it just going to be the US that's going to benefit from it? Right? If other places like Europe benefit from it, if we sort of see a global benefit from it, then I would argue it's the places that are sort of more bargain price that have the most to grow. So, it's always hard to bet against the US. I believe in being a diversified investor, but I'm certainly not putting all my money into the US today. I think it's a good idea to have sort of a global perspective. And it also just helps with diversification. But that's where my money is. I'm putting some money everywhere.
Mm-hmm. And I mean, literally, whenever y'all's the Shiller Cape Index came out globally, and in an industry itself, I don't know if you know all the back and forth with it, state regulations, but literally, a lot of these illustrations just show terrible back testing. And once again, your narratives and basically the model, the infrastructure of the core principles of what y'all operate off of, y'all wanted to go globally, and the results have been there. So,
Yeah.
if you're feeling it, that's the continued trend. Pretty optimistic with it. And I know as we're wrapping up, any final thoughts as we are closing out here?
Yeah. So, having worked for a long time with this sort of value-oriented product, I did mention it rotates into growth sectors, but sort of being a more fundamentals-driven product, I can see the struggle that a lot of people have today. They're very excited about AI. And this is sort of the hardest time to really be a disciplined investor, to be a value investor. But I think it's important not to get too caught up in the narratives, or if you do, to really think about whether those narratives are justified, or if you're sort of more just having this fear of missing out. And, I just leave people with, just stay diversified. If you are a value investor, if you're based on fundamentals, when the bubble is running up, which this, it looks like prior bubbles. I'm not saying this is another bubble, but when the bubble's running up, that's the most difficult time to sort of stand with your principles and remain disciplined. I wish everyone, whichever choice you make, the best of luck. I hope that many of these clients are able to have a long, happy, and wealthy future.
Yeah. Well, no, we appreciate the academia mindset, the not just research that your team and others do. I mean, it just helps the industry, and it helps customers too feel confident when they have smarter people than themselves, essentially, looking at these products and having a second opinion. So appreciate your time, Ben, for hopping on today. And thank you also to the listener for tuning in to this week's episode of the Advisor Mentorship Podcast. Subscribe on your favorite listening device, and also subscribe to our YouTube channel at Jeremy Hauser AMP. And remember, as you are sharing this episode with a friend or a colleague in a world full of betas, be an alpha.